Good day, investors. In this video, we will take a closer look at Blue Owl Capital stock, ticker symbol OWL. Blue Owl has been a solid dividend payer over the years and has also been a strong performer within the alternative asset management and private credit sector. The company has grown very rapidly, expanding its assets under management and building one of the largest platforms in the private credit industry. However, despite that strong growth, the stock has been under significant pressure recently, even though the underlying business continues to perform well. The reason for this appears to be the current market headwinds affecting the private credit sector, as investors have become increasingly concerned about rising interest rates, potential credit risks, and overall liquidity conditions in alternative lending markets. As a result, the stock has sold off recently as investors grow more cautious about the broader risks within the private credit industry. So in this video, we're going to break down the company's latest earnings results, why the stock has been under pressure lately, the key risks investors should understand, and whether the current valuation might represent a buying opportunity. But before we get into it, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming videos. Thank you very much. Now first, let's go over the company's latest results and key highlights from their latest earnings report. Starting with fundraising, Blue Owl Capital had a very strong year. In 2025, the company raised about $42 billion in equity capital, which represents more than a 50% increase compared to 2024. Institutional fundraising was also very strong, reaching roughly $24.7 billion, an 80% increase year over year. The company also saw strong growth in the wealth channel, where fundraising for wealth-dedicated products increased about 58%. On the investment performance side, many of Blue Owl's strategies also delivered solid returns. For example, some of their credit funds generated around 10 to 11% returns, while other strategies such as ASOF delivered close to 19% returns. In the real assets segment, funds like OREF and BODY also produced strong double-digit returns, and the Blue Owl GP stake strategy generated roughly 28% IRR since inception. So overall, when we look at the results, the company continues to raise large amounts of capital while also delivering solid investment performance across its platforms. As of the end of last year, Blue Owl Capital had over $300 billion in assets under management, and the company operates through three main investment platforms. The first is the credit platform, which is the largest part of the business and focuses on direct lending and alternative credit investments for private companies. The second platform is real assets, which includes investments in areas like real estate and digital infrastructure, where the company provides capital to large tenants and infrastructure projects. And the third platform is GP Strategic Capital, where Blue Owl takes minority stakes in other alternative asset managers and provides financing solutions to private equity firms. Together, these three platforms allow Blue Owl to operate across multiple areas of the alternative investment market, which has helped the company grow its assets under management very rapidly over the past several years. The company's track record on fundraising has also been very strong, with capital raised increasing steadily over the past several years. Back in 2023, the company was raising roughly around $4 billion per quarter on average. By 2024, that number had increased significantly, and in 2025, the company was consistently raising more than $10 billion per quarter. And of course, this growth in fundraising is important because more capital raised ultimately leads to higher assets under management and higher fee income over time for Blue Owl Capital. So overall, the fourth quarter results for Blue Owl Capital were strong, with solid financial performance. During the quarter, the company generated about $416 million in fee-related earnings and roughly $382 million in distributable earnings. Assets under management also continued to grow, reaching about $307 billion, and the company raised over $17 billion in new capital commitments during the quarter. And finally, the company continues returning capital to shareholders, with an annual dividend of about 92 cents per share announced for this year, along with share buybacks. However, despite these strong results, the stock has still been under significant pressure recently. So the next question investors need to ask is, Why is the market becoming more cautious about Blue Owl right now? The main reason is that the market has become increasingly concerned about the private credit industry as a whole. Over the past several years, private credit has grown extremely quickly as banks pulled back from lending and private investment firms stepped in to fill that gap. This created a huge opportunity for companies like Blue Owl Capital, which has built one of the largest private credit platforms in the industry. However, that rapid growth has also started to raise concerns among investors and regulators. One of the biggest concerns right now is credit quality risk. Private credit funds lend money directly to companies, often with floating interest rates, and when interest rates rise, borrowers suddenly face much higher interest costs. That can increase financial stress on companies that already carry a lot of debt, which could potentially lead to higher default rates in the future. Another concern is liquidity risk. Many private credit funds allow investors to periodically withdraw their money, but the underlying loans themselves are relatively illiquid. So if a large number of investors request withdrawals at the same time, funds may have to limit redemptions or sell assets, which can create additional uncertainty in the market. There are also concerns about valuation transparency. Unlike publicly traded bonds or stocks, private credit investments are not priced continuously by the market. Instead, they are typically valued using internal models, which can lead some investors to question whether the current valuations fully reflect potential risks in a more difficult economic environment. And finally, there is fundraising risk. Companies like Blue Owl depend heavily on raising new capital from institutional investors and wealth platforms. If investors become more cautious toward private credit as an asset class, fundraising growth could slow down, which would ultimately impact assets under management and future fee income. So even though the underlying business continues to perform well, these broader concerns around the private credit industry have created significant pressure on the stock recently. So with that in mind, the next question investors should ask is whether the recent sell-off has created an attractive valuation opportunity. Looking at the current price, Blue Owl Capital is trading at around $8.75 per share, which is close to its 52-week lows. At this price, the company has a market capitalization of roughly $5.8 billion. One thing that immediately stands out is the dividend yield, which is currently around 10%. That is a very high yield for a company in the alternative asset management industry. Looking at the earnings multiples, the stock is trading at a forward price-to-earnings ratio of around 9 times forward earnings, which suggests that the market is pricing in quite a bit of uncertainty. Another interesting point is that analysts currently have an average price target of around $17 per share, which would imply potential upside of more than 100% from the current price. However, it is important to remember that the market is currently discounting the stock because of the risks surrounding the private credit industry that we discussed earlier. So the key question for investors is whether these risks are temporary headwinds or whether they represent a more structural problem for the industry. If the private credit market stabilizes and Blue Owl continues to grow its assets under management, the current valuation could potentially look very attractive over the long term. Personally, I think the valuation looks quite interesting at these levels, but investors should also remember that the stock will likely remain sensitive to developments in the private credit market. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching and happy investing.